Okay, so we should be recording. So we're picking back up and we are into the provincial abatement. So we're going to flip to slide 4 on deck number 3. And so first of all, the rationale for the provincial abatement and why we have it is that the provinces need to be able to levy corporate tax as well. Again, the provinces have a very just constitutionally limited in the types of taxes they can raise. They're generally limited to direct taxes only. So corporate tax is a fairly important provincial revenue raiser, in addition to being a fairly important federal revenue raiser. And so the provinces, as long as we're going to have separate provincial taxes, they need to be able to raise provincial corporate tax revenue. So what the provincial abatement is doing is it's creating room for the provinces to impose tax. So the assumption that Parliament makes in having the provincial abatement at 10% is that provinces are going to levy tax at, or are going to levy corporate tax at a flat rate of 10%. Obviously, this assumption is not correct. Alberta is under 10%, and every other province is over 10%. So nobody's really trying to stick with that assumption, but that is the assumption on which the provincial abatement is based. And it's actually, and again, this is where we have you're going to start to see as we talk about dividend taxation, how there's differences between there's differences between the maximum top marginal rate for individuals and the integrated rate of corporate income plus shareholder income when you have corporate tax and then a dividend paid from after tax retained earnings. And this is one of the things that drives that difference, is the provinces not taxing at the rate that the federal government assumes with a 10% provincial abatement. So something to keep in mind there. In terms of how it works and the more technical minutia, the provincial abatement is found in subsection 124(1), and it works by providing a 10% deduction from the general rate in subsection 123(1). So that general rate in 123 sub 1 is the 38% rate. So a 10% reduction means that any income that qualifies for the provincial abatement is subject to federal tax at a theoretical rate of 28% after taking into account the provincial abatement. So in terms of conditions that have to be satisfied for the provincial abatement to be available, income has to be earned in a province and in order to qualify. And again, you'll see this a little bit in international tax when we talk about like foreign branches and stuff. Like, it is possible to have income that's not earned in a province and subject to Canadian corporate tax, in which case there just wouldn't be provincial tax, and you would instead have potentially there wouldn't be provincial tax. You would just have additional federal tax by having no provincial abatement. But for our purposes, we're going to assume that all income is earned in a province. Subsection 124 sub 4 provides that whether income is earned in a province is determined under the regulations. If you then flip to the regulations, you're looking at regulations essentially 400 to 402. And what they do is they allocate a corporation's income between provinces based on the provinces in which the corporation has a permanent establishment, which is a defined term in Regulation 400. And the allocation is made based on the relative revenues and wages of the corporation. So revenues earned and wages paid as between permanent establishments of the corporation. When you're thinking about a permanent establishment, basically any conceivable fixed place of business is a permanent establishment in the province. If the corporation doesn't have a permanent establishment otherwise determined, but like it owns land in a province, that's a PE. If it doesn't have an office or land but it has a registered mailing address in the province, then that's a PE. And failing anything else, it has a PE in the province under the laws of which it is incorporated. So you can't have a Canadian incorporated corporation with no PE. There's going to be a PE somewhere. And so if there's only one PE, all of the income gets allocated to that province under the regulations. But the moral of the story is, as long as it's allocated to a province under regulations 400 to 402, the income qualifies for the provincial abatement. And in this course, we're going to assume that all income is attributable to a PE in Canada because it's just too difficult otherwise, and you would kill me. So we're not going to do that. However, I will note that I do expect, even if we're assuming away the fact that all income is earned in a province because it's attributable to a PE in a province on an exam, etc., I do still expect you to point out that the provincial abatement is being taken into account and what its effect is. So don't assume away the provincial abatements. Moving on to our next point. This is now slide 5. We have the general rate reduction percentage. And so, like we talked about before the break, the effect of the general rate reduction percentage is to reduce the corporation's effective rate of tax determined under subsection 123(1) by 13%. And so after factoring in the provincial abatements in subsection 124 sub 1, the effect of the general rate reduction percentage is to decrease the federal rate on eligible income to 15%. So reasonably straightforward so far. Then the next point on the side is, well, where is it found? It's found in subsection 123.4 sub 2, which is the actual rate reduction itself. Then there's a definition of general rate reduction percentage, which matters in actually applying the reduction, and that's found in subsection 123.4 sub 1. And so then the next question on the slide is, well, when does it apply and to what income? And so in order to know if the general rate reduction percentage applies, you need to know if the income that you want to apply it to is full rate taxable income, which is again a defined term in subsection 123.4 sub 1. Basically, full rate taxable income is income of the corporation that does not if it's a CCPC, it's income of the corporation from a business that does not qualify for the small business deduction and is not earned from a personal services business. If the corporation is a non-CCPC, the full rate taxable income is basically all of the corporation's income. So putting this another way, if you have a CCPC, full rate taxable income is income that is not small business deduction eligible, is not from a personal services business, is not from a source that is property, and is not from capital gains. So it basically business income in excess of the small business deduction limit for the corporation. Non-CCPCs, income regardless of the source is full rate taxable income. So then, if everyone's okay with that, then we flip to slide 6, and we have the small business deduction, which is the next potential rate setting item. And we're going to talk about the small business deduction quite a bit as we move through the course, and especially as you're going to see, A lot of the complicated stuff in corporate tax is really just strictures to control access to the small business deduction. And we can talk a lot about, as we go through the small business deduction, why we do this and why we put up with these strictures, et cetera, especially when now, it's only a 12% reduction versus general rate in Alberta. Is that worth it? But anyway, we will get there later on. So again, going through the same basic questions we have for the provincial abatement and the general rate reduction. In terms of effect, in 2021, the effect of the small business deduction is to reduce the CCPC's tax rate on the first $500,000 of qualifying income, which is income from an active business carried on in Canada, by 19% from the 28% post-provincial abatement rate. So this cannot be combined with the general rate reduction percentage. I mean, obviously it can't be combined because it would result in a negative tax rate. But even if you thought a negative tax rate was possible, and theoretically is, but even if you were going to dabble with negative effective tax rates, it just can't be, because the definition of full rate taxable income carves out any income that's small business deduction eligible. So you've got to be picking one or the other. It's not so much a choice, but it's going to be one or the other that you're going to have apply. So, the handouts mentioned here, and again, we're going to talk about this in much more detail, that associated groups, which you don't know what that means yet, but associated groups have to share a single small business deduction. So it may be that even a corporation that's earning $500,000 or less of business income may not have any small business deduction available anyway, and then therefore doesn't get the small business deduction and just gets the general rate reduction percentage instead. But in any event, the effect is that 19% reduction from the post-provincial abatement 28% rate down to a federal rate of 9%. In terms of where it's found, the small business deduction is found in subsection 125 sub 1 and sub 1.1. Subsection 125.1 describes the qualifying income in respect of which a corporation may be entitled to the small business deduction. And subsection 125.1.1 specifies what the rate of reduction in respect of that income is. And then part 3, which question 3 on the side, which I think I've again kind of already stated. The small business deduction is available for income earned by a CCPC from an active business carried on in Canada to the extent of the first $500,000 of income from that business. And, again, we're going to talk about what is or is not income from an active business carried on in Canada later. So don't worry if, there's some loaded terms in that sentence fragment. So don't worry if you're not sure what all those loaded terms mean. We're going to cover that later on. So then if we're all good there, we can flip to slide 7. And this is now, we're talking about the additional tax on CCPC investment income. So we've concluded our corporation is a CCPC, but we've concluded that our income is neither small business deduction eligible, nor is it eligible for the general rate reduction percentage. So it is going to instead be subject to the additional tax on CCPC investment income. Like I mentioned earlier, investment income is not full rate taxable income as defined in subsection 123.4 sub 1. It does not qualify for the small business deduction because it's not described in subsection 125.1, and in any event is not income from an active business carried on in Canada. And so as a result, no small business deduction. And instead what happens is it gets subject to, under section 123.3, to an additional 10 2/3% tax on that income. So the result is that you have a federal rate of 38 2/3% on the investment income of a CCPC. So we're going to talk more later about what investment income of a CCPC is and is not. For just the purpose of wrapping your head around this right now, investment income of a CCPC encompasses most types of what you would think of as income from property, so interest and rents, dividends from non-Canadian corporations, and capital gains. It does not include income from a Canadian resident corporation dividend income from a Canadian resident corporation. We're going to talk about that separately. Again, there's a different regime that applies to portfolio dividend income. But yeah, leaving that aside, basically think of investment income as interest, rents, royalties that are not for self-created intangibles, capital gains, and so on. So we're also going to talk about this later, but what you're going to see is that a large, basically all of this 10 2/3% tax is refundable to the CCPC, and the effect of the refund is actually to drop the net of refund rate on investment income to 8%. So really, this additional tax is really an anti-deferral mechanism rather than a permanent tax, and we're going to see how that works a little bit later on. So do keep that in mind. This is why you're often going to hear this 10 2/3% tax referred to as a refundable tax, because in substance it in fact is. So is everybody okay there? Okay, so then we can flip to slide 8. And slide 8 is dealing with personal services business income, which again does not qualify for a nice rate. First of all, what is a personal services business? A personal services business is a business carried on by a corporation of providing services where a specified shareholder of the corporation would be an employee of the service recipient, but for the existence of the corporation. So, many loaded and defined terms in there. Basically, a specified shareholder of the corporation is a person who owns either themselves or together with related and non-arm's length persons, owns 10% or more of the shares of any class of the corporation. So, basically a fairly significant shareholder. If the corporation is rendering services using that person, and that person would be an employee of the service recipient, but for the existence of the corporation. And in fact, it's not even so much a but-for test, it's a would reasonably regarded but-for. So it's a question of fact with a but-for test tacked onto it. Then it's a personal services business. And so, if that sounds a little bit weird, keep in mind the reason why people do this is they're trying to avoid employment relationships for both income tax and for employment law purposes and income tax purposes. But for the PSB rules, this would work because sort of like we talked about last week, under employment law, only individuals can be employees and corporations cannot. So this is where I usually depart on a little bit of a rant. I've written a couple papers about this, that I think the PSB regime generally is kind of a bullshit thing that attacks the wrong side of the transaction. Like the assumption that we're making with the PSB regime is that it's the would-be employees who are choosing to avoid an employment relationship. Finance is assuming that they want to income split with their spouses and claim deductions that employees are not allowed to take, and therefore are trying to avoid employment relationships between corporations. When I think in reality, what is actually happening is that employers are trying to foist corporations onto people to have them not be employees. Because if you are a contractor through a corporation, you're not protected under labor laws. You can't, so like the Employment Standards Act doesn't apply, right? You can't join a union because you're not an employee and therefore you're not covered by the Labor Relations Act. You're not qualified for any employment benefits. You're not entitled to severance pay, all of that stuff. So, and as well, the employers don't have to pay employer side payroll taxes like the employer contributions under the CPP and the employer premiums under the Employment Insurance Act. So, what we've kind of done is we've created this regime that is potentially quite punitive, as we're going to see in a second, potentially quite punitive for employees or would-be employees who end up carrying on a personal services business, and lets the people who are often mandating that they be in those relationships off entirely scot-free, where they just get what they want, and the employers are the would-be employees are eating it through the tax system, which is kind of a raw deal. So rant over. Moving on to the next question on the slide, asks about the effective federal rate. So, well, if you have a personal services business, then what happens is that there is you don't qualify for the small business rate, right? Because the small business deduction, the definition of active business carried on in Canada that we use for that purpose excludes a personal services business. You don't get the general rate reduction because the definition of full rate taxable income in subsection 123.4 sub 1 excludes personal services business income. So you're stuck at 28%. But worse, there is then an additional 5% tax that gets imposed. So the federal rate goes up from 28% after the provincial abatement to 33%. And so this is an interesting result, right? Because it's a pretty big swing from 11%, which is a small business deduction rate, to 33%, which is the personal services business income rate. And this comment will make more sense when you understand how dividends get taxed, which we're going to see later, and the fact that there's different effective rates for different types of dividends based on the source of the underlying income. But what you can see is that as you would expect, basically everybody who's in one of these potential personal services businesses will always file their returns, their corporate returns, on the basis that they're earning small business deduction income. And then typically these people are spending what they make, so they'll pay what we call non-eligible dividends, which are taxed at a higher rate, as we'll see in a couple of weeks, based on the assumption they've earned small business income. And then the CRA will come along and they'll assess on the basis that there's a personal services business. So the corporate rate has gone up now on a reassessment from the 11% paid to 33%, plus obviously provincial taxes. The provincial taxes go up too, but we can just set that aside for 1 second. And then, but you've still paid tax as the employee or would-be employee on a non-eligible dividend at a higher rate than you would have if you were, if you were otherwise taxed, if you were otherwise carrying on a business. But the overall result is that you end up with like a 60% integrated personal shareholder. Integrated corporate shareholder rate, which is much higher than the 48% top marginal rate. So it's kind of you get whipsawed pretty huge here now, right? As a result of having paid non-eligible dividends and not having the general rate reduction or the small business deduction and that additional tax plus the additional provincial tax. So it's a really raw deal. And certainly if you're If you're going to be in practice, you're going to see this because there's lots of accountants who have clients who are potentially in personal services business, especially in Alberta. The oil services sector is rife with these potential PSB structures. And so you'll come across this quite a bit where people are looking for some kind of a determination about whether their business is a PSB or is going to be wanting to appeal from a CRA determination that the business is a PSB. And it's like I said, it's kind of a raw deal for these people who just have no idea what was going on and then get whipsawed pretty hard. Again, rant over. Part 3 of the question is just asking what provisions apply. As I mentioned before, the term personal services business is defined in subsection 125(7). And the general rate reduction is inapplicable in this case because of subparagraph A3 of the definition of full rate taxable income in subsection 123.4 sub 1. So those are the important definitions that you care about. So moving on to slide 9, we have specified investment business income. And this distinction that we have between an active business carried on in Canada and a specified investment business is one of the most important and contentious distinctions in the corporate income tax world, certainly as it applies to CCPCs. Income from an active business carried on in Canada is entitled to the small business deduction, at least to the extent of the first $500,000 of income, whereas the income from a specified investment business is not entitled to the small business deduction and is in fact subject to that additional 10 2/3% tax under section 123.3. So there's a very big swing, right, between the combined Canada-Alberta 11% rate and the combined Canada-Alberta 46 2/3% rate on investment income. So that's a huge, it's a huge potential cleavage, right? So the term specified investment business is defined in subsection 125(7), as noted on the slide. For our purposes, it means a business carried on by a corporation other than a business of leasing property that is not real property. The principal purpose of which is to derive income from property, including interest, dividends, rents, and royalties. However, the business carried on by the corporation is not a specified investment business if the corporation employs more than 5 full-time employees in that business, or would employ more than 5 full-time employees in that business if associated corporations did not provide services to the corporation carrying on the business. So that is an important distinction. There's really 2 very important distinctions here. That one with the employees is an important distinction between more than 5 full-time employees and not more than 5 full-time employees. Bright line test. Keep in mind here what the Federal Court of Appeal has said is that more than 5 full-time employees does not mean 6 full-time employees. It just means 5 full-time employees plus something more. So if you have 5 full-time employees plus a part-time employee, you're good. And keep in mind again that the services provided to the corporation by associated corporations are to be factored in here. So if you have, let's say 4 full-time employees employed in the business by the corporation, but there's an associated corporation that provides the equivalent of, let's say, 3 full-time employees worth of services to the corporation, then on an aggregate basis, you're fine, and you're not in specified investment business territory. So, why you have, why 5 there or more than 5? There's really no magic here to that number. What it does is it makes sure that a reasonably small activity like owning an apartment building that might require some labor, and in fact enough labor to be a business, based on that common law distinction between income source that is business and income source that is property. It makes it irrelevant and it makes it a specified investment business, but at the same time, it makes sure that somebody who's carrying on a very substantial business of earning income from property is not, is not subject to the refundable taxes, because they do have the kind of substance that we would require to be a business. So obviously, the fact that this is a bright line test, like every bright line test, can create really stupid results. And so there was a recent case out of Quebec. I'm blanking on the name off the top of my head, which is the difference between 2021 Mike and 2015 Mike. When I started doing this course, I would probably have known this, still been able to remember this. But there's a recent case out of Quebec. And in that case, for example, the corporation employed only part-time employees. It was running a storage business, only employed part-time employees, all of whom were senior citizens. The rationale being obviously that if you have part-time employees are treated differently under your employment standards legislation and generally entitled to lesser benefits. And also senior citizens don't like to work that much. So they had like the equivalent of like 16 full-time employees, but were all part-time employees. And so they lost. Right, they went to court and were arguing they weren't a specified investment business because they employed more than 5 full-time employees, but they lost because they employed 0 full-time employees. And again, there's a really stupid distinction here, where if they had set up a separate labor corporation that employed, they set up a separate labor corporation that employed all 16 part-time employees or 16 full-time equivalent part-time employees, and then had a management services contract to provide services to the storage operating business, they would have won, because the associated corporation would have provided the equivalent services of more than 5 full-time employees. So yeah, this is one of those things where everyone loves bright line tests until they start to burn you in a really stupid way, as happened in that case. The other thing that you need to keep in mind here as well with the specified investment business concept is that there is the other place where you see disputes, and you will see disputes in practice, is a distinction between a services business and a business that a business of earning income from rents. And so where people have been running these cases lately has been on things like RV parks, where they've been arguing, and so there was a recent case here too. It was like Hidden Valley RV Park was the name of the case, I believe. And there was also a numbered, if you have your Sherman Acts and you're looking at the definition of specified investment business in subsection 125.7, there's also a numbered corporation case that's cited as well, which also involved like an RV park. And so the argument here that people are making is, well, we provide services. We're not carrying out a business of earning income from rents. Like, we're not renting the RV pads. We're providing services. People care deeply about the services that are being provided by your RV park. Like, we had a magician come in every 2 weeks because RV people are lame and enjoy magicians because they're like 6-year-olds with big cars. So they tried that out, and obviously, not obviously, but predictably lost. So, again, but that's somewhere where there's, again, it kind of a cleavage, right? That where carrying on a services business, like if you operated a motel, you would be treated differently than if you operated an RV park, because when you stay at a motel, you care about the services, right? You care about the room being kind of clean, et cetera, that there's going to be housekeeping every once in a while, and somebody's going to be watching the front desk and, there to maybe call them, et cetera. So a difference there to be wary of as well. So then, again, that quasi information quasi rant out of the way, we can go to our last basic rate slide, which is slide 10. And this is just asking about provincial tax rates. And so we've figured out through the last few slides how we're getting to our effective federal rate. How it's either going to be 38 2/3% if it's income from property or specified investment business. It's going to be 9% federal rate if it's a small business and a small business deduction eligible income. It's going to be 15% if it's general rate, full rate taxable income that's subject to the general rate reduction, or it's going to be 33% if it's a personal services business. So now we can layer on provincial rates. And so the general Alberta rate is found in section 21 of the Alberta Corporate Tax Act. And I believe we're down to, they keep adding a new paragraph every time they change the rates, which have happened quite a bit since they moved to the Alberta Corporate Tax Act as a tax and statute. So I believe we're now in paragraph 21T, and that provides for a corporate tax rate of 8% in 2021. So that's the general Alberta rate. The provincial taxes are generally simpler. There's really only two. There's a general rate that applies to everything other than small business deduction eligible income, and then there's a small business rate that applies to small business deduction eligible income. So for the small business deduction eligible income, you can take a look at subsection, this is just the stupidest thing, subsection 22 2.1297 of the Alberta Corporate Tax Act, which provides for an Alberta small business deduction of 8%, which means that the effective Alberta small business rate is 2%. And that small business deduction has actually, that 8% has now for 2021 been dropped to 6%. So the 8% is the legacy number, the 6% is the current number. So having a reduction of 6% from an 8% rate obviously gets you to 2%. So combined effective rates, which is the last point on the slide, in 2021, the combined Canada-Alberta tax rate on general rate income, so full rate taxable income as defined in subsection 123.4 sub 1, will be 23%. So that's when we talk about the general rate, that's what we're talking about, is that 23% rate on anything that qualifies as full rate taxable income. The small business deduction rate for income that is eligible for the small business under subsection 125.1, that is subject to tax at a combined Canada-Alberta rate of 11%. For personal services businesses, which again are not full rate taxable income and which have an additional federal tax, the effective rate is 41%. And then for our CCPCs that are earning investment income, which includes specified investment business income, and which is not included in the definition of full rate taxable income. Again, that rate is combined federal Alberta 46 2/3%, which is 38 2/3% federal and 8% Alberta. So those are our combined rates. Does anybody have any questions on what we've talked about for the last 45 minutes or so? Okay, seeing none, the next thing we're going to jump into is probably too long to start on. There's just no realistic way we're going to make any progress in 5 minutes. So I'm just not going to do that. and we can all, I would say go home would be my normal thing, but we're all home already. So we can all go back to doing something that isn't corporate tax. Or, well, you will, I will not, because I have to go continue to work. So 17 of us will go do something that is not corporate tax, and one of us will continue to do actual corporate tax. So have a good weekend, everyone. Thanks for joining, and we'll see you next week when we will do the remainder of topic 3, and we're going to do topic number 4. So for the next class, we're going to finish handouts 6 through 9, and I believe it's handout number 10 that is the related, associated, affiliated persons handout or handouts. We're going to cover that stuff in the next class as well. So once you get to the end of all the diagrams in handout 10 or whatever, that's where we'll finish.